$73 billion flowed into AI startups in the first quarter of 2025 alone. That's a 470% jump from last year. But here's what matters. This isn't a rising tide lifting all boats. This is a tsunami hitting one beach while the rest of the coast goes dry. OpenAI raised $40 billion in a single round. One company, one round. That's the largest private tech funding in history. And Anthropic's $13 billion in Q3, and you're looking at two companies absorbing more capital than entire sectors used to see in a year. The numbers tell an uncomfortable story. 60% of all global venture capital is now going into mega rounds. Deals over $100 million. In North America, it's 70%. Compare that to 2021's peak, yes, we saw similar dollar amounts, but the money was distributed across food tech, robotics, health tech, and everything in between. Today, AI foundation models and infrastructure are eating everything. While foundation model companies feast, other sectors are experiencing their worst funding environment in decades. Biotech investment just hit a 20-year low as a share of overall funding. Cybersecurity deals retreated in Q3 despite every company claiming they needed better security. Seed stage deals down sharply, even though individual seed rounds are getting larger, meaning fewer founders are getting their shot. So here's the math that should concern you. 48% of new unicorns in 2025 are AI companies. That sounds exciting until you realize it means 52% of innovation is fighting over the remaining capital. And nearly half of all that venture funding, 46% globally, went to AI companies in Q3 alone. The concentration runs deeper than startup funding. Microsoft is spending $80 billion on AI data centers this year. Just Microsoft. The four largest cloud providers combined are spending over $200 billion. This is the California gold rush dynamic, except now, instead of thousands of prospectors, we have a handful of megacorporations building picks and shovels. This concentration creates three risks you need to understand. First, supplier dependency. If your AI strategy relies on OpenAI, Anthropic, or a handful of other foundational model providers, you're betting your business on companies that are themselves dependent on massive continued investment and haven't yet proven sustainable unit economics yet. Second, innovation bottleneck. When 60% of the capital flows to mega rounds, breakthrough innovations in non-AI sectors don't get funded. The next generation of climate tech, advanced materials, or novel therapeutics might be sitting in someone's garage because VCs only have the bandwidth for AI deals. Third, bubble dynamics. The question isn't whether we're in a bubble. We clearly are when single companies raise more than most countries' GDP. The question is what happens to the broader innovation economy when it pops. In 2022, when the correction hit, funding dried up everywhere. This time, with the concentration even more extreme, the collateral damage could be worse. So don't mistake funding volume for market health. Yes, $73 billion in Q1 is massive, but when that capital is flowing to fewer than 50 companies while thousands of others fight for scraps, that's not a boom. That's a distortion. For executives making AI investment decisions, understand that you're not just betting on AI capabilities, you're betting on a market structure that's historically unprecedented and potentially unstable. The companies getting funded today are the ones with existing traction or revenue. If you're moonshot foundation models, if you're building something in the middle or in a non-AI sector, your funding environment just got significantly harder. The AI revolution is real, but revolutions built on this much capital concentration rarely end smoothly. Plan accordingly. Bye for now.